The rand weakened in early trade as the US dollar rose. The currency is trading at around 18 rand 90 against the dollar. Gary Booysen is the portfolio manager at Rand Swiss, and he joins us now to take a look at the latest market moves. Gary, thank you very much for your time. Let's start with the rand weakening in early trade. What's driving moves there?
Yeah, so we're seeing a little bit of risk-off sentiment filtering into the market today. Obviously, we were closed yesterday, and I suppose we've got a little bit of catch-up to play. But we've got some concerns around the banking and the property sector in China just filtering into the market. People very, very concerned that the stimulus measures that have been put in place aren't enough to essentially rescue a beleaguered property sector there. There's the fear of contagion, specifically into the wider markets, and that's prompting a little bit of trade into the safe haven assets like the US dollar. It's one of the reasons that we're seeing the dollar index up to around 106. So that's a measure of the US dollar versus 6 of its major trading partners. We're feeling that in the rand dollar exchange rate as well. So that's kind of knocking on the 19 rand to the dollar door once again. At the same time, there's the looming specter of a US government shutdown as soon as the 1st of October, and that could potentially mean a lot of economic data is not going to be released. The idea that the US Bureau of Labor Statistics just will not be publishing non-farm payrolls. So definitely something that's concerning markets. We're seeing the US 10-year rising to new highs, just again as that fear kind of filters into the markets. On the index level, we have our index, all-share index down around 1.4% currently, and the selling is very, very broad-based. Financial index down 1.2, industrial index down 1.7, resource index down around 1.3. So it really is broad-based. We had Hong Kong down around 1.5% this morning, and we've got Paris, London, Frankfurt all down in negative territory at the moment. So a little bit of risk off. September is traditionally a bad month for equity markets, so maybe an opportunity for viewers to go and top up on some of their longer-term holdings.
Okay. Gold prices drifted lower today as the US dollar and Treasury yields climbed. Help us make sense of those moves.
So at the moment, with risk off, essentially you're seeing selling in the bond market. When the bond market sells off, yields become relatively more attractive. People require more interest to hold on to that kind of debt. So yeah, a little bit of spike that also makes let's say treasuries more attractive. So if you are looking for a safe haven asset and you have a choice between parking your money with the US government or buying physical gold, gold of course gives you no yield whatsoever. You're essentially relying only on scarcity. You're saying that at some point in the future inflation will take care of your return. So when you see higher interest rates available on something like a US dollar, that becomes relatively more attractive, and generally you see the gold price falling in that case. It is obviously very, very volatile and can turn around at a moment's notice, but I think with the high yield that you can now get on current dollar balances, you're seeing investors prefer that to more traditional safe havens like gold assets.
The last week of September is one of the busiest on the economic calendar. What to look forward to this week at least?
So there's a lot out this week. So we've got some PPI numbers on Thursday. So that's South African PPI numbers. Previously, we saw a jump of 2.7%. We're expecting 3.7% as some of those base effects work through the market. And of course, inflation data is absolutely key in this high interest rate environment. Any weakness that we see in absolute price levels, will feed into expectations that we might potentially see some relief from the Reserve Bank. We've also had the South African business indicator out. We saw that on the negative side, the commodity price index has been hurting us, as well as new vehicle sales. But there has been an increase in the average hours worked in the manufacturing sector that helped to lift it into positive territory once again. We also have money supply figures out on Friday, as well as private credit extension figures. So a lot of stuff to look at going into the end of the month, and you can expect that to play out in the likes of the currency. As each number is released, we would expect to see some volatility based on the result.
Allianz Global Wealth report is out for 2023. Talk us through some of the findings.
So it's interesting. So if you look at it, South Africa really has been bucking the international trend. So this report looking at what happened in 2020, and as you'd expect with financial markets being very weak last year, we saw an absolute decrease in financial assets across the globe. So the average drop was actually the largest since the global financial crisis. You're looking at a decrease of 2.7%. As I said, South Africa interestingly bucked that trend, and we actually saw a growth of 1.7% in South Africa. So if you compare that to let's say pre-pandemic levels, if you're looking in nominal terms, so without adjusting for inflation, our financial assets, privately held financial assets have actually grown 22.3% since the pandemic. Of course, we're entering a higher inflation environment. So if you adjust that for inflation, it's only up 5.9%. But compared to if we compare that to the global peers, since the pandemic, if you adjust for inflation, global financial assets have only grown 6.6% since the pandemic. So South Africa, while we get very negative on the local economy, we are actually managing to build wealth in South Africa, which I think is a very positive thing. Another interesting finding in the report is also just the level of debt that we're seeing globally, and the narrative is that everyone is drowning in debt and that private sector credit extension has just become so widespread, and the figures don't actually reflect that. And we're actually seeing similar debt to GDP levels, private debt to GDP levels that we saw in the early 2000s. And the real theme that you can draw from the report is that there's actually been a shift of debt levels from the developed market to the emerging market. So as the emerging markets become more sophisticated, you're seeing higher levels of debt in the emerging markets, but definitely constrained borrowing in the developed markets. So, interesting report, and I think telling us a lot of what we already know. 2022 at least was a very, very difficult year for financial markets, and we have seen obviously a rebound in equity markets already. So you would expect the report for next year to look a lot better.
It is quite interesting. You mentioned that the report knows that we are managing to build wealth. Where?
That's in private households, so it doesn't go into the underlying segmental reporting. But I think from a South African point of view, we have higher interest rates, we have very high savings levels compared to developed markets, and that would have stood us in good stead, specifically in the fixed income markets, where you obviously are attracting a much higher yield than you would in the equity markets that got absolutely punished.
And the debt figures that you speak of, does it actually break it down into the kind of debt when you say that, well, the narrative that is being created that we're over-indebted is not quite accurate?
Oh, no, it's not that we're necessarily over-indebted or under-indebted. It's just saying that comparatively speaking, we're sitting at around the same levels that we saw, as I said, in the early 2000s. So the idea that you've seen this explosion of credit extension, over the last 20 years, is not accurate. And on a personal level, however, it can be very, very different. So the idea of what is right for an economy or wrong for an economy is very unique to each individual country. And of course, the report spans around 60 countries, so it's quite difficult to get into each individual finding.
Fair enough. Gary Booysen, thank you very much for your time this afternoon.